Paul Kitson, UK Head of Pensions Consulting at EY, and welcome to the Reimagining Pensions podcast, the podcast where we talk to a number of guests over the coming months about how they are reimagining pensions. I'm joined, as I will be throughout the run of this podcast, by my partner in crime, Charlotte Moore.
Hi, I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Delighted to be on the podcast.
Thank you, Charlotte. So, with all the reform going on in pensions and retirement at the moment, we wanted to give a platform to talk to some of those at the coalface of pensions reform and reimagining pensions. We have lined up over the coming months a number of great guests who are going to tell us what they're doing in the industry and how they are reimagining pensions. But I could not think of a better place to start than being joined by John Hamilton, trustee chair of the Stagecoach Group Pension scheme, who has quite literally just finished reimagining pensions. And I'm sorry, you're going to hear that phrase quite a lot, but I promise maybe not to say it anymore today. John, perhaps you'd like to introduce yourself.
Yep. Hi. Really pleased to be the first guest on this new podcast program for pensions. Just completed a really interesting transaction, I think groundbreaking transaction, where we really did reimagine how best to run on pension schemes with a focus on member outcomes and also aligned to the sort of government sort of perspective and growth. So yeah, really pleased to be here at the most interesting time for our industry in the last 20 years.
Yeah, thank you, John. I could not have put it better myself. And look, thank you for giving us your time today. The transaction certainly has sort of taken the industry, I think, by storm in terms of people talking about it and how people are already starting to think about how it might apply to them. But maybe let's jump straight into it. Perhaps, John, you could just talk to us for a little bit about how and perhaps why the trustees did this transaction.
Sure. Let's start with the why first before we go on to the how. We're at a critical point of change for UK pensions, having had 20 years of chasing deficits and filling deficits, and a regulatory framework which is structured around covenant failure and fear of default. We now know, and based on the recent Purple Book, as a universe of the 1.2 trillion of UK private sector DB schemes, we're sitting on $250 billion of surplus. So things have changed. And I mean, the trustee board, which I'm chair of, the Stagecoach Group Pension scheme, it's a 1.2 billion scheme. We are, as happen chance, about 1,000th of the universe of all the schemes. So if you look at Stagecoach and multiply it by 1,000, that brings you back to where the universe is. So again, without disclosing too much in terms of confidentiality, we are about 1,000th of that universe. We're a 1.2 billion scheme. The universe has got a surplus of about 240 billion. And that really does, that change position created a whole set of different questions for the trustee. And this is still on the part of the why. And so, I mean, the scheme is well funded, could have afforded a buyout, but very cognitive of once you do a buyout, that's a once only irrevocable decisions. And two things kind of informed our thinking on that. We were very aware of the requirements of TAS 300, which says when you're going to make this once in a lifetime decision, review all the alternatives, form a proper view on the best way forward. The other thing that influenced our thinking a lot as part of that was when you're in surplus as a trustee, we considered that the perspective of your duties changes. You're no longer concerned about default. And certainly when you look at all the various alternatives and run on to insurer, the risk of default across the system is very similar. It's really quite small. Whether you call it 1 in 100, 1 in 200, 1 in 300, they're all really small likelihoods of default. And certainly in terms of the TPR low dependency framework, that's what it's designed to do. It's done its job. So we kind of considered we as an industry are ostensibly in surplus, and certainly my scheme was in a surplus as well. The other thing that influenced our thinking a lot, and this takes us back to the Good Report of 1993, what is your job as a trustee? When you're in surplus, and when you consider that actually the risk of default is minimal or consistent across a range of alternatives, we considered that our obligation changed more to protect the value of the pension. The previous narrative for the last 20 years has been structured around can you maintain just what's been promised, the bare promise? most pension schemes have got a whole bundle of inflation caps. And certainly when you do a buyout, you buy in and you lock in those inflation caps. We considered when you're a trustee and you're sitting on a whacking big surplus, limited default or default, can you actually, per the goods report, again, reminding you what your job is. Your job as a trustee is to pay a pension to someone that keeps parity with real prices over the term of their retirement. And remember, when these things were first envisaged 20, 30 years ago, life expectancy might have been 5, 10, 15 years. If you're paying someone a pension now for 20 to 25 years and you know it cannot keep pace with inflation, you really must question your responsibility as a trustee. So that's kind of the why we got into this. And I guess the why was fully funded. You just have to, I mean, we consider as trustees, if you look at TAS 300, and TAS 300 version 2 was reissued in 2024 following the sort of the gilt reset. It was reissued in the context of how can pension schemes remain involved in the economy for longer and support growth. But if you go through TAS 300 V2 and you do the work, you kind of assess a list of credible alternatives. And in terms of our board, we looked at a lot of alternatives, whether that's just straight run-on, whether it's third-party capital, whether it's captives, all of the alternatives you can imagine. That one of which, and it happened to be the last of which came on our table, was the Stagecoach Aberdeen shared ambition run-on. And so that was the why we got into that. What was our job? And we'll come on to some of the details on that later. But when you do the analysis, and if nothing else, what I hope the transaction brings to the industry is just take time to do that assessment. And it's an interesting exercise when you do it. So that was the why we did it. Do you want to go into the how, or is that enough as an introduction for the why?
I think that's a great introduction to the why. Just in case you've been sleeping under a rock for the last couple of months and you don't know what the deal is that we're discussing, it'd be fair to describe as a transfer of sponsor from Stagecoach to Aberdeen, which, as far as I'm aware, is the first time anybody's done that. Is that fair to say, John? So maybe that can lead us into the how.
Well, that's interesting. Yeah, I mean, change of sponsor actually happens quite a lot, usually when there's a corporate takeover reorganisation. So again, this transaction was fully floated, discussed, considered by the regulatory bodies. And so the mechanism that was used was just what you normally do in a corporate transition. But you're right, this was a rather unique transition because the actual corporate transition was just of the pension scheme. And so, I mean, Stagecoach Group, they'd managed the scheme for 30 years, funded it, a lot of money put in, and helped deliver it to this position of a significant surplus on a low dependency basis, over £200 million on a £1.2 billion low dependency basis. Stagecoach have got other business interests. They've still got 23,000 members in their DC scheme, so they were keen to focus and simplify their business. At the same time, the trustees determined through their TAS 300 analysis there was a lot of value on the table. Where is that surplus going to go? And so again, we went through a whole range of alternatives and assessment, and we'll talk about the TAS 300 detail in a moment, because that's kind of critical. It's kind of critical that the industry starts to coalesce around what is a TAS 300 report, what things can and should you and must you take into account. So the transaction was quite simply, we replaced Stagecoach, quite simply Stagecoach with Aberdeen as the sponsor. Okay, there's quite a lot of mechanics to that, but that's fundamentally what was there. And from a trustee perspective, we replaced one sponsor with a stronger sponsor covenant, with guarantees, etc., underpinning that. And I guess, so we replaced the sponsor. Aberdeen, what's in it for Aberdeen? Well, what's in it for the trustees? I guess part of the unique outcome here was we run on, and we run on for surplus. We've got a fully funded scheme. It had been fully de-risked. It was suitable to hand over to an insurer. And the question is, if you run this on as an insurer, the insurer takes the assets and they re-risk. And we just looked, can we run on like an insurer? So if we run on like an insurer with a financially astute sponsor, what does that do in terms of the expected outcome? So we change sponsor and we run on. We re-risk as an insurer would do to run somewhere around gilt plus 1.5. So still cautious basis, still within regulatory guardrails, and still fully hedged with the risk battened down. So that effectively is a transaction. But we run on, There's a framework in terms of how the trustee will operate. I mean, the trustee and rules, nothing changed, everything continues, the trustees' discretions continue. That's an important aspect, actually. When you run on, you retain your discretions. When you've got a 20 to 25% surplus, you retain those discretions and you retain the ability to at least have a discussion with them. What we've done with Aberdeen, we had an open discussion and a negotiation, and we have mandated, we've frameworked that any surplus that's generated going forward, that will be split 2/3 to the trustees, and the trustees have absolute unilateral discretion how to apply that, and Aberdeen, they get 1/3. What's in it for Aberdeen? Well, they take on the rest, they get 1/3 of the upside. They also get a priority go at being the investment manager. Ultimately, the trustees has got the decision over that, but for just now, Aberdeen on an arm's length investment management perspective. So that was the how. I mean, from our perspective, it's the same trustee board. Aberdeen get 1 or 2 participants. The union representation are still on the board, but the scheme runs on. And what we want to do now is for this transaction to settle, we just keep doing what we're doing, running on a cautious basis, generating compounding returns over the long term. Critical for this trustee board, what's in it for us? Well, go back to the good report. I mean, our scheme was a compilation of nearly 60 schemes over 30 years with a whole myriad of caps all over the place. On entering into the transaction, we uplifted members' pensions as a one-off increase, and we removed a whole lot of those inflation caps. That's the intention. If they're affordable, then they're all removed, and we've got one cap now, 5%. What I want to happen is we run this on over time, that cap can be removed or put higher, or we get more discretionary increases. So that's the what we did, and we were looking forward to just running on as a pension scheme within the pension environment as normal.
And can I just jump in? Sorry, Charlotte. Already I'm jumping in over you, but just you mentioned the sort of regulatory piece that would have gone through, and of course, only to the extent you feel able, and obviously anyone else considering this transaction for themselves, they'll need to think about how the regulation applies. But I just wondered if there's any more you can say about how the regulators kind of engaged on the process as you kind of went through it.
Yeah, I mean, we had a very detailed engagement with the regulator. We from the point of time where it was clear there'd be an exit from the scheme for Stagecoach, we engaged with the regulator and a really open dialogue. I mean, some really good people, they're a good team, open dialogue of what we want to achieve. We think there are merit. We said we think there's merit in running on the scheme. We want to do that in a way where everyone's happy, where the trustees are happy, where the regulator's happy. And really, I mean, the regulators issued quite a lot of guidance on this. They've got their seven steps for innovation. They've got an innovation director. They've got people who want to have this discussion. And it wasn't an easy process. These things require a lot of information and data and checking the guardrails. So all that happened. But I was going to say it's a positive experience. I don't like to apply that phrase to regulatory oversight, but it was a healthy part of the process.
It's as good as you can get.
To get everyone comfortable. So I can't disclose much more than that, other than regulators were fully cited on the full transaction, and there were no red flags from their perspective. That gives me comfort as chair of trustees, and I'm sure it gives the new sponsor comfort, and it gives the old sponsor comfort on the transaction. But I mean, what I would say is the regulator was ready. They are there, and they're inviting innovation and discussion, and put it on the table. Just tell them what you want to achieve and what the guardrails are that you think are appropriate.
They're inviting pensions to be reimagined. I said I wouldn't say it again, but there you go. I've broken that rule. Charlotte, sorry, go on. Please.
What was helpful as we did a comparison of a range of alternatives. I mean, TAS 300 version 2 is a helpful standard, but what's missing is there's no pro forma, no one knows how to apply it properly. I mean, I've seen some TAS 300 sign-offs that are one line. This complies with TAS 300, very good. But actually, the TAS 300 V2 in terms of assessing, and what you're instructed to do is, when you're about to, as a trustee, make an existential decision, get rid of the scheme, you should just pause. And that's kind of the guidance that's kind of spun out of the Mansion House Accord. There's a lot of value on the table here. Make sure you understand what you're doing. So we went through it made us just design a framework for every one of these structures, from capital, from covenant, from the member outcome, from the investment profile, from the hedging ratios, from the guardrails, from the regulatory regime and the regulatory protection. That's critical. I mean, what was really critical was this, having a proper understanding of FSCS versus PPF when you run on, and that gives some interesting outcomes. And I say it's a very, very cooperative exercise. Once we had that framework, that helped us to sort of form the way forward and support our decision making.
So the question I wanted to ask is, given that you have done this innovative deal, do you think that opens up new possibilities for other DB schemes? Have we got a third way, to quote Tony Blair, rather than just buy out or run on? Do you think you're going to see other schemes copying what you've done, or do you just hope that it frees people's imaginations about what they can do with their pensions?
Yeah, I mean, there's a lot of unique circumstances fit into what we did. We had the option of 2, 3, 4 different alternatives. So what I hope happens from this is that, and what should happen, trustees and advisors at least ask the question, okay? And so what are the range of options ahead of us? But there are two things in this which are absolutely critical, and it comes back to growth and member outcomes. The universe for which we have responsibility, we the pension industry, 1.2 trillion. Our job is to pay those 60 billion of pensions per annum. Now, if you look at the Purple Book today and you accept that valuation system, we are sitting on $250 billion of a surplus. The simple question is, where does that surplus go? What happens to it? And it either sits there, or we park it off to the insurers. But if you park it off to the insurers, which is kind of the accepted wisdom, certainly from the insurers, what do the insurers do with that de-risked universe of schemes? They re-risk them. And so that universe of assets is going to carry some risk, probably around about gilts 1.5, gilts 175. The question is that done within an insurance regime or the pension regime? And if it's in the pension regime, done by trustees, you retain that ability to access and use discretions. And so for our scheme, and what I hope happens for the universe, is trustees just think, and regulators think, there's $250 billion of surplus there. Where does it go? How much of that goes to members? And in a strong covenant, fully funded regime, where inflation is going to become a dominant concern again, I would just urge people to have a think about that seriously. The second point, Charlotte, we've discussed this before, is the need for growth. I mean,
you're going to talk about my favourite chart, aren't you?
Yeah, there's the OBR paper 2024. I mean, the sort of government spending against government revenue is just colossal. You should take that forward a generation. And there's not enough money in the system to pay these pensions. If we park half of our pension universe into gilts, I mean, gilts is just future taxes. There's not enough future taxes to pay them, you know. And the people who are going to ask to pay those gilts, the Gen Zers, they're going to have no loyalty to our pension promises we made ourselves. And so we need to put growth back into the system. And there's a question, again, it's a structural question, is that growth going to be more attainable through a relatively tight insurance regime or more scope through the pension regime? I mean, you get my sense. I think pensions are designed, or the pension regime is designed for pensions. And so I favour that regime strongly. But we need to change the mindset. It's happening. I mean, government now understands it needs growth in the system. And I'm hoping we as an industry know we need growth in the system, and we need to take a little bit more risk, and we need to protect people's pensions against inflation. So yeah, I'm hoping that people will come to their own conclusions, but we need to look at the bigger picture, our overall responsibility, and also the potential to pay these pensions in the future.
It's a really good point, John, and a really important connection. I think too often in the UK we seem to kind of view, pensions as completely separate from UK growth, or even, if they're supporting UK growth, then it must be bad for individuals, kind of the members. So I think you're right. Like, thinking about those two things together is important. So one question I think we like to ask all of our guests is, if they were to have a magic wand to reimagine pensions, what would be the one thing that you would do? What might be the one thing you would change about the system? Or if we could have a clean sheet of paper, what change would you make?
That's fascinating. If I was to do one thing, how long have we got?
You only know one. That's the only downside, I'm afraid.
The simple, most effective thing we can do, and it's the right time to do it, is we need to have the foresight and the courage to amend the TPR remit. Just now, the TPR remit, probably the heaviest weighting, the most dominant thing, is the TPR's job is to protect the PPF. Now, that was relevant when the PPF was fledgling organisation, but we have a PPF now that's done a fantastic job. It's run by well-skilled people, well hedged. It's overfunded to the scope of 14-15 billion. We no longer need to protect the PPF. The job of the PPF, the job of any insurer, should to be provide the framework, the base work against which others take risk. So if I could reimagine a pension universe, I would modify the remit of the PPF such that its job would be to support and encourage member outcomes and investment in growth within appropriate regulatory guardrails. Keep it within the pension regime. If we don't, then to some extent the PPF and the TPR become self-fulfilling out of a job. They pass their job over to the insurers. I'm just not sure, and we have some fantastic insurers, but I'm not sure that's their job, insurance. Insurance and annuities and pensions, investment and growth are different things. So, long answer. If I had one thing, it's time, after 20 years, to revisit the remit of the PPF to make it contemporary for the 21st century.
That's actually less radical than I thought you were going to be, John. I don't know whether to be happy or sad about that. So you're not asking for a fundamental reevaluation of how we value pension liabilities, which you could argue that was really the big thing that changed how we viewed risk back 25 years ago or so.
Well, it's all connected. If you think your job is kind of paradoxically, the way we have saved pensions is by shutting them all down. Okay, we've eliminated growth from the system. If you think your job is to provide a pension that keeps parity with real prices across the system, then that single change. We're not frightened of pensions. We're not going to squish them. We're going to see pensions as a moral obligation, that pensions as a source of funding and investment. Then that simple remit will fundamentally change how we do things. Now, we might think that one of the good things about being old is you understand the benefit of time. I remember when I started managing my scheme 20 years ago, it was 200 million, 220 million of a fund. And when a year or so ago, it was 1.5, 1.6 billion. I could never comprehend that 200 million would go to 1.5 billion. This is 3 years ago. But that, once you remember the impact of compounding, if you can compound at 6, 7, 8% for a generation, that's how we fix our growth issues, by having a little bit of courage to invest in compounding returns.
Go on, Charlotte.
No, go ahead, Paul. Go ahead.
Well, I was just going to say, as you say, sort of really interesting thoughts, and be one to debate later. I guess, assuming we don't, unfortunately, kind of have the magic wand, as you say, there's still a really number of interesting things coming out of the transaction you folks have done. Is there more practical steps that you think we can achieve as an industry, to kind of hopefully reimagine pensions in a good way, absent our magic wand?
Lots of things. I mean, it's just to be reminded we're in this for the long term. We need growth. There's a generation of people in pensions like me. We need to anticipate the next generation coming through. So invest in development, succession, understand. I mean, the financial crisis was 2007-8. It was 18 years ago. Time moves quickly. So we must invest in those who come behind us, and just have the confidence to invest. I mean, we have a fully funded scheme on current basis. Even if we only invested the whole of the surplus, the 250 billion for growth, we can lock down and hedge the first 800 billion and invest the rest. But there's no way through this other than investment and growth, and to accept it's a long term journey.
So when you say that investment for growth, are there things that you have in mind that you're thinking of? Is there things that people should be doing with that surplus capital to grow it and to return it to members and to bolster the economy as well? Well,
that's interesting. I mean, I'm not a fan of mandation, although we've had mandation for the last 20 years in terms of the regulatory frameworks flipped us to gilts. We've had soft mandation. What we need to do is gradually unwind that, basically. I mean, the reality is the government cannot allow pension schemes to sell off the 600 billion in gilts, so we need to respect that reality. But the rest of the money, we can gradually start to increase the level of risk on the portfolio. That's kind of core. Now, that investment doesn't need to be in UK. It can be anywhere from my perspective. In fact, the ideal pension is the rest of the global economy pays your pensions. But the UK and the US are the most open liberal markets. If you have our pension schemes investing, by default, they will find open liberal markets with the rule of law. And so the UK will get its fair share. We've just got a bizarre situation where we have not supported, in fact, we've specifically disencouraged our schemes from investing, and they've done that by not investing in the UK. There's been no major investment or innovation come out of UK in terms of the FTSE the last 15 years. And so you've just got to plant more seeds to grow more apple trees.
Mm-hmm. And that is obviously where you have the benefit of the pension versus the insurance regime, because you have greater latitude to do something that's, not crazy risky, because you don't want to risk that surplus, you want to lock that in. You do have more options than you would under an insurance regime.
Yeah, there's a balance there. You've got to have some crazy risky stuff, and you've got to let entrepreneurs give them the capital to make those decisions, and some fail and some survive. You can't only back the winners, because that's not going to work. But yeah, you've definitely got to do that. Now, I said, there's a sort of irony here. We in the UK have world-class asset management and financial services, which we deploy for the rest of the world, but not ourselves. It's bizarre, isn't it? So we just need to start to use some of our own pension money within our own financial system, and a big proportion that will trickle into UK investment and growth. So yeah, you just got to have the courage. But don't underestimate this disinvestment lag from the TPR for a generation has had a material impact. We need to just gradually unwind the de-risking dial and dial up the investment dial. But again, we should have confidence in the role of the PPF. And the PPF's well run, it's well funded. Pension schemes and trustees should be able to take an element of risk, and they've got support of the pension structure underneath them.
I think you're spot on. We talk a lot about right risking at EY. It's getting an appropriate amount of risk. Neither too much, but equally a lot of damage can be done from not enough. And we're in our sort of final few minutes, John. But I'm keen on this series that we ask our guests their view on how they think the pension system might change for the younger generation, those kind of accruing benefits today. Again, you as a chair of a DB trust, you could take the fifth and say that's for others to kind of prefer a view on. But I'd love just to pick your brains on CDC. Do we think that's going to be a thing? There, I'm sure we'll be talking to guests on this show who might even be saying DB could come back. It will look different. It will be in a different shape. But I'd love just to pick your brains on where the longer term future might go.
Okay, you throw me a curveball. This wasn't part of the script, or part of the preset questions, but we'll give it a go. Yeah, I only have one or two messages. In terms of the overall transaction, just do the numbers, okay? Do your task 300. And if you don't do that, if you don't put in the energy to do that work, then do the energy to protect yourself from the class action that's going to follow. You're obliged to do the work. In terms of the future, I have a strong belief for the working person who works in the shop, who works in a factory, who goes in day out, self-employed. The degree of paternalism should be strong. So yeah, I do believe in collective delivery mechanisms. I believe in collective investment and collective risk sharing. So I think CDC must be the way forward. And if you invest over the whole cycle, we know that gives more. So I think CDC must be the way, and we as an industry need to be brave, and the regulatory system needs to be brave as well to deliver that for the future. Going back to the OBR forecast we discussed a few moments ago, pensions are but a promise, aren't they? They're a bit of paper. In 10 years' time, it's the economy that's paying your pension. And if we don't invest in our economy, in our kids, in their education, in their jobs just now, they'll be the electorate in a generation's time. The Gen Zs, they'll make different voting decisions on our pensions unless we support them now. So yeah, it's got to be collective, it's got to be investment, it's got to be growth. And that's what's worked for the last 50 years, and it can work for the next 50.
Well, I think that makes a great place to end this first podcast, because we've now opened a whole new can of worms, which we'll probably explore with future guests. So I just wanted to say thank you, John, for being so brave and being the first guest on this podcast, and for sharing your insights so expertly and with such great humour as well. Paul, I'm going to hand over to you for the handoff.
Yeah, no, well, look, thank you again. Let me just add my thanks to John for speaking. Let me add my thanks to all those listening. Thank you for joining us for the first podcast. I hope you found this interesting, enlightening, it stimulated debate. Please look out for our next podcast wherever you consume your podcast. You can tick the subscribe button so that you can make sure you're informed about when our next podcasts are coming out. But I think that just leaves me to thank John, thank you, Charlotte, thank everyone for listening, and wish you all an excellent day.